have another reader comment on the video channel over at YouTube, and it's on the video. When should I move my protective stop to break even? It's from Steve Davies 5231. Important video again. Thanks. A question regarding funding or capital allocation. How do you approach the transaction? Does a client transfer you the money and do you trade it? Do they deposit it into an exchange and allow you to access their account or something else? Well, I've talked about how those of you who want to get into the business of running other people's money pretty extensively. If you go to the website, at least for the time being, you can see where there's some discussion on allocation and getting backers and otherwise. I know on Spotify there's some audio only content that I was doing long before I really started making bigger time investments to the YouTube channel, where you could look it up as well. You have to always think about appropriateness of investment, right? So whoever you're speaking with, you want to make sure, just like I say to you, you have to talk with your financial advisor to figure out if any type of trading is appropriate for you. And that's true regardless of whether you're a scalper or you're a long-term trend follower, position trader, and any other asset classes that you could possibly trade. I don't know what's appropriate for you, so you have to figure that out. Once the client has made up, his or her mind that that's something that they want to do and that you can help them, the easiest way to do it is, to have the client set up what's known as a separate account. And that would just be them opening up any type of brokerage account, either at a broker dealer or at an FCM, a futures commission merchant, if they're on the commodity side. And in some instances, they might have an introducing broker as well. All that means is that the introducing broker is probably going to be doing a lot of the front end, a lot of the marketing. They might have certain website features that are available to potential clients, but the money isn't actually custodied by those people. It was held, like back in the day, Bear Stearns did a lot of this kind of correspondent clearing business. And, today there's other entities that do that. And then that person, the client, would fund the account. It would be their account. It would be their P&L. It would also be their level of taxation, right? Which is different than if you set up a commodity pool or a hedge fund where the legal gets really expensive, right? So you'd have to have tens of thousands of dollars for legal and accounting in order to get that going. So you'd have to know that you have access to probably tens of millions of dollars, where your upfront investment in the legal would make sense because you could earn it back in your fees and amortize that against, say, the commodity pool itself. You're probably looking at 20, 25K in legal if you wanted to set up your own pool. If you wanted to set up your own fund, again, you're looking at a lot of regulatory environment, a lot of compliance, and a lot of legal to get your documents up and running. Separate accounts are easier because all you're really getting from the client, after all the disclosures that you make in your risk disclosure document. How do you charge your fees? What's your process for handling the money, asset allocation, trading rules, blah, blah, blah. You have to spell all of that out. You also have to delineate all the ways that they could possibly lose money, including a clause that talks about force majeure. So you basically have to try to talk to people out of doing it in the first place, which kind of seems counter emotional. So you don't have to worry about custodying the money. That'll be done by any of the entities out there that your clients might want to deal with. And it's always good to let them figure it out, because delegate it to them. You don't have to worry about that. If you have a relationship with a broker dealer or FCM, and sometimes those entities are regulated, are registered concurrently as both, you can just let the client pick the account that they want to be with for whatever reason. And then what they typically do is you'll sign some type of a document made available by the entity, the clearing member, the custodian of the assets, that speaks to what we would call third-party trading authorization. And that would just be where everyone's on the same page, both the custodian, broker-dealer, FCM, and you and the client are all on the same page, where they understand that you will be making the buy-sell decisions according to your rules. And you'll probably have to sign that piece of paper. And that's how that works. So the client, basically handles all that on their own. You can kind of coach them, but you do want to be aware of like what the marketing rules are. And the rules are kind of strict in terms of, I don't, I want to just answer this in a one or two sentence because you can go down a rabbit hole. Depending on where you live, meaning what state, if you're in the United States, the rules on how you can market yourself as an unregistered investment advisor are pretty specific. So you want to kind of look that up. There are de minimis exemptions, but again, you want to be super clear about because what you can do and what you can't do is not necessarily night and day, but the rules are different from state to state. I'll give you an example. As long as you don't hold yourself out to the public necessarily as an investment advisor, right? Or maybe a commodity trading advisor, there are de minimis exemptions which state something along the lines of if you have fewer than XYZ number of clients over a rolling 12-month period of time and you don't hold yourself out to the public, which means you don't have a website, you don't have social media where you're talking about your trading, right? Because that's all marketing in the eyes of the regulators. So you have to read the language very clearly so that you remember there's the letter of the law and there's the spirit of the law. And you want to be always on the side of the latter because you don't want to open up a can of worms in your world that way. If clients are approaching you on an unsolicited basis, that's another ball of wax. I'm pretty sure like if you go to nfa.futures.org, you can see like what are the requirements for registration as a commodity trading advisor or as a pool operator and where those exemptions are. If you go to the Department of Corporations for whatever state that you live in, you can look up what the rules are for what are the requirements for an investment advisor in terms of registration and all this and that. So it can vary it's similar. They can be similar from state to state, but they also could be very, very different. So there's not any one particular answer. You're still going to need documentation. You probably want to document everything. That's just a good idea. They say good fences make good neighbors. So for sure, look up and find a way to create your own. And I don't have the resources here to kind of help you with that. So, because I don't want to get into that type of consulting. You'll have to figure that out for yourself and look it up. But you do want to have client agreements. You want to also be able to demonstrate how do you charge your fees? When do you charge them? What's a typical calculation look like? I know in the commodity space, in your disclosure document, you also have to, if you're showing hypothetical results, they have to be clearly labeled as hypothetical. And if you have actual results, there's a calculator that they actually make available to you so that you can calculate your returns in a way that's within compliance. Now, if you go ahead out and get registered, there's fees to pay, and then there's fingerprints, and there's all this and that, and then you need to get it used to be that you would just submit your disclosure document. Now I think they actually review it, and they have to approve it before first use. Then it had to be updated within, it can't be more than 9 months old. So some of the language might have changed. You have to go look at it yourself. But the good news is that there's a lot of information that you can go read yourself and try to make heads or tails of it. And then, kind of figure out how to get clients without, overstepping your bounds or getting into areas where you're outside of compliance, because they can still give you a cease and desist even if you're not registered. And it's pretty serious business. So you don't have any business with the exchange. It's the member firms that are members of the exchange that would custody a client's funds for either equity, options, commodity futures, or whatever the instruments are. They would already be in there are rules and regulations for those entities as exchange members, and then there's rules and regs for the people who run the money. Anyway, hope that answers the question. If you like this video, there's more right here.